Wow.
Florida promised ease. Now it delivers a reckoning, with numbers to match. Start at the very top. In Manalapan, a single buyer moved on a compound priced at $75,000. 16,000 square feet, a bowling alley, a private theater, a tunnel to a beach cabana. The land? 1.94 acres, once tied to a music legend. The buyer has been busy. In just 2 years, he has accumulated roughly $170,000 of property in this narrow slice of Palm Beach County. 2 additional development parcels sit nearby, with a combined offering contemplated at $125,000. This is what concentrated capital looks like when it meets a coastline with limited supply. Step back from the shoreline, and you see a broader map, a state where price trajectories diverge. Forecasts for 2026 show the national median rising by 2.2% year over year. Under that average, nearly a quarter of the top 100 U.S. markets are expected to fall. 4 of the 10 steepest projected slowdowns are in Florida. Cape Coral leads with a forecasted drop of 10.2% in 26. Northport follows at 8.9%. Deltona and Tampa are each pegged at 3.6% lower. In Florida's 8 largest metro areas, median sale prices for existing homes and condos are expected to slip an average of 1.9% in 2026. The state has already been bending. Statewide median listing prices fell 6% in the first half of 25, compared with the same period in 2023. This is the story of a bifurcation. Ultra-luxury at the top pulling against a middle tier strained by the cost of holding a home. One South Florida enclave hosts a $75,000 move-in ready estate with furnishings included and a private dock. Across the peninsula, owners compare rising insurance premiums, HOA fees, and special assessments against wages that move more slowly. The result? A cooling in some metros severe enough to post double-digit declines in year-ahead projections, and a reshuffling of who can stay, who must sell, and who is waiting for a better entry point. Look at how we got here. Florida's magnetism is not new. Population flows accelerated in 2020, with a surge from the Northeast, Illinois, and California. In the hunt for sunshine and space, the internet made it easy to browse on a couch. Mortgage rates initially dropped, and demand ignited. By May 2022, the median sale price in Florida jumped 20 to 3.8% year over year to $405,900. Go back further for context. In May 2017, townhouse condo median prices sat at $178,000, while single-family existing homes were at $239,000. In Cape Coral, the run-up was even sharper. Local pros talk about prices rising 65 to 70% during the pandemic boom. That kind of sprint rewrote budgets for buyers and sellers across Lee County. But then came a pivot. Inflation grew hot. Mortgage rates climbed from around 3% to near 7%. The shock slowed sales. Price growth went from sprint to standstill in many corners of the state. For some metros, small declines gave way to larger ones. Signals suggest that buyers recalibrated, and some owners who could no longer carry the monthly load decided to list. By the first half of 2022, Florida's statewide median listing prices were 6% lower than in the first half of 2023. The fuel for that easing? Not just higher rates. Insurance premiums rose. HOA fees and special assessments jumped, especially in condo buildings adjusting to new safety rules passed after a catastrophic collapse killed 98 people. In this environment, buyers are no longer just weighing a purchase price. They're running the math on maintenance, reserves, and risk. The rules changed after Surfside. Condo associations were required to get current on inspections, fund reserves for structural repairs, and stop deferring fixes. That has a cost. In one Jensen Beach complex called Villa del Sol, a 2023 engineering review tallied roughly $3,100,000 in work, about $43,000 per unit. Roofs, electrical boxes, structural elements that cannot be ignored. That is the new arithmetic of ownership along parts of the coast. Faced with those numbers, some owners took second mortgages, others listed. And in many zip codes, condo units have piled up on the market, unsold, as buyers balk at the new carrying costs. That is not theory. it's lived experience. In 2017, a family with a dog bought a condo at Villa del Sol for $209,000. They moved in 2 years later, in 2019, drawn by the ability to walk to the beach and the flexibility of a pet-friendly community. In 2023, the structural study came back with that $3,100,000 price tag. Their portion, 40%, $3,000. They chose to stay, took out a second mortgage to fund their share. Their unit had been appraised for about $580,000. Then, in August 2024, 3 buildings in the complex were deemed unsafe to occupy. Residents were told to evacuate with only hours to pack. Their son was days from starting a new school. The family had to move fast. They found a rental 40 minutes away to keep school continuity. Carrying a second mortgage for a unit they could not live in, they watched a tax collector listing appear for $43,000. Credit scores fell. Savings eroded. They withdrew from retirement accounts. By November 16, 2005, permit applications to repair the structures were filed. By December 5, 2025, those applications were approved through review and invoiced. Repairs can begin once fees are paid. The property manager said construction is starting in December, bringing engineers and a contractor to push toward habitability. That timeline defines the gap between a policy on paper and its very real costs on a family's life. Zoom out again to the market. For many longtime owners, the Post-Surfside changes arrived alongside a separate squeeze, a statewide insurance market grappling with litigation, fraud, and a run of more frequent and more severe natural disasters. The result was higher premiums layered over taxes and utilities. In Boca Raton, one owner tried to keep total monthly expenses below $2,200 to $2,300 and discovered it was no longer possible. Insurance alone ran about $2,300 a year. Special assessments for deferred work could be as high as $20,000 per unit. In St. Petersburg, fees jumped more than $300 per month to above $800, with a $4,000 special assessment added on top. Then property taxes moved. One new residence bill climbed from $1,400 to $4,000. Homeowners insurance doubled to $2,800 on an 834-square-foot home. Even an electric bill, $175 for a vacant house in July, felt like part of an avalanche. These aren't just one-off complaints. They are the measurements owners bring to the closing table or to a realtor when they say, "We need to sell." That is why the cooling is not uniform. It touches condo-heavy communities first. It presses hardest in places where special assessments were long deferred and then, by law, had to be funded. It's also why some Florida metros are projected to fall further in 2026 than Western markets famous for volatility. Compare. Stockton is expected to drop 4.1% in 2026, Sacramento by 3.3%, San Francisco by 2.5%, Raleigh by 3.7%, Spokane by 3.5%, Denver by 3.4%. In Florida, the floor lowers more quickly in certain pockets. Cape Coral is forecast at negative 10.2%, Northport at negative 8.9%, Tampa and Deltona at negative 3.6% each. That spread tells a story about local conditions that cannot be reduced to a single interest rate chart. Cape Coral offers a sharp case study. During the pandemic, demand for sunshine and affordability pushed prices up by 65 to 70%. Then Hurricane Ian struck. After Ian, more homes came to market, and sales slowed, a pattern that compounds an already cooling cycle. In recent years, area prices have slipped 5 to 10% from their peaks. Local dynamics point to 22-6 as a buyer's year. The expectation is a larger selection of homes, reductions from list, and more frequent builder and seller incentives. Those incentives matter. They are the lever that turns a maybe into a contract at a time when holding costs can make the difference between moving and waiting. Step into Southwest Florida's conversation, and you find the region organizing around data. In Fort Myers, the largest real estate summit in the area is dedicated to data over drama, an evening event from 4:00 to 7:30 p.m., where land use, new home sales, and commercial trends are dissected by a cross-section of local leaders. Names in that room include a land and development CEO, a residential brokerage president, and a commercial managing partner. The sponsors tell a parallel tale, a building industry trio tied to Lee, Collier, Charlotte, and DeSoto counties, alongside banks and big builders. The event's premise is simple. The next move in 2026 and beyond depends on the numbers. That mantra fits a Lee County of contrasts, a fast-growing Cape Coral on one side with a projected double-digit decline, and a builder's bench ready with incentives on the other. While the mid-tier resets, the very top keeps flexing. The $75,000 Manalapan purchase comes fully furnished, with a tunnel to sand and an ocean to lake footprint that can't be replicated. The buyer's broader footprint, about $170,000 in 2 years, signals a strategy measured in parcels, not months. Selling 2 combined lots for $125,000 has even been considered. The money behind it comes from an automotive accessories company that generates an estimated $800,000 in annual revenue, and the owner's net worth is at least $2 million. This is old-line manufacturing wealth, anchoring itself on one of the most expensive zip codes in the country. The effect is real. Decisive capital atop a very limited stack of trophy properties can stabilize values at the apex even as the middle reprices. The middle-class Florida dream isn't a relic. It's a math problem, and the inputs changed. Between 2017 and 2022, median prices moved from 6 figures to the $405,900 statewide mark in May 2022, a 23.8% year-over-year jump. On a single building in Jensen Beach, reserve obligations translated into $40,000 to $3,000 per unit when structural repairs hit $3,100,000. When mortgage rates ran from around 3% to near 7%, monthly payments changed without any move in listing prices. Then, some costs doubled elsewhere. A homeowner's insurance bill at $2,800 on an 834-square-foot home forces a buyer to rerun affordability calculations. A $4,000 property tax bill wipes out the perceived savings from a lower list price. You can feel that tension in the places where condo units are stacking up unsold. You see it in the first half of 2025, where median listing prices across the state were 6% below the same period in 2023. Policy is an active variable. After the Surfside collapse took 98 lives, the state required inspections, reserve funding, and hard deadlines for associations to stop deferring repairs. Those reforms created near-term pressure. In July, additional reforms took effect, extending some deadlines for key assessments and giving certain associations more time. But not all buildings can use that relief. Where a structural integrity reserve study was already completed, some communities are now fixed to a track they cannot slow. That's why you can find associations where special assessments near $20,000 are in play, insurance runs to $2,300 a year on top of that, and the monthly HOA line climbs by hundreds. The intent of the law safety stands. The friction shows up in listings and in price reductions that arrive before a reserve account is fully funded. Another policy front is property tax. Proposals are moving that would slash property taxes on owner-occupied homes. The immediate effect could be meaningful relief for existing homeowners. But watch the ripple. Lower carrying costs can boost demand and lift prices, especially for primary residences. That shift could create pressure for those looking to buy and for renters who won't benefit directly. It also raises a budget question for counties and cities tasked with funding police and fire. If the tax base on homesteaded properties shrinks, those services must still be paid for. The balance will matter as markets hunt for equilibrium in 2016. Across the state, affordability is now a conversation about carry. During the boom, many buyers could price in appreciation. In 26, the carrying costs on day one dictate whether a deal works. That's true in Tampa, where a 3.6% decline is in the forecast. It's true in Deltona with the same projected drop. It's visible in Northport with an 8.9% expected slide, and in Cape Coral, where minus 10.2% points to a reset year. It is shaped by insurance premiums that jumped, HOA fees that climbed, and assessments that arrived all at once. It's reinforced by higher mortgage rates relative to the 2021 floor. And yet, Even in the face of those headwinds, demand doesn't vanish. It reorganizes. Investors look at concession-rich new builds, primary buyers wait for incentives, or step into condos where reserves are already funded, or focus on inland neighborhoods less exposed to storm risk. Signals suggest the market is not crashing, it is normalizing. One Colorado metro offers a hint. Denver's growth rate is projected at negative 3.4% in 2200, a move viewed locally as a normalization rather than a collapse. The region sits at a 3.6-month supply of inventory, a metric used to gauge balance between buyers and sellers. That's not Florida, but it frames the idea. More inventory means more choice, and more choice means negotiations shift. Florida's version of that shift shows up in Cape Coral's expected incentives, Tampa's forecasted dip, and condo-heavy submarkets where buyers focus on the full balance sheet, not only the list price. There is no single Florida. In Palm Beach County's Manalapan, a billionaire building a multi-parcel footprint can swing $125,000 in potential land plays and still view it as patience, not speculation. In St. Lucie County's Jensen Beach, a condo valued at $580,000 before evacuation can find itself listed by a tax collector at $43,000 after engineers deem buildings unsafe. In Boca Raton, a unit owner faces $2,300 for annual insurance and contemplates a $20,000 assessment. In St. Petersburg, a fee schedule moves by $300 a month to above $800, with a $4,000 assessment layered in. The math can force moves. One family relocated to Georgia after August 2024, their son cycling through 4 schools in a single year because life had to keep going even as permits were filed on November 16, 2025, and invoices were issued by December 5th. If you want to picture the next 12 months, picture checklists. In Fort Myers, a Thursday evening long session is devoted to land, new homes, and commercial momentum. The presenters, one from a land services company, one from a residential brokerage, one from a commercial firm, are set to reduce the noise to data. From 4:00 to 7:30 p.m., sponsors that include a regional realtor association and multiple builders line up alongside a bank. The reason is obvious: Southwest Florida's 26 will be made in the details. Incentives per door, lot availability by subdivision, flow of insurance renewals, pace of reserve funding in affected condos. These aren't headlines, they're inputs. One overlooked detail: as prices cool, not every region softens equally. California metros like Stockton, Sacramento, and San Francisco show projected declines between 2.5% and 4.1% in 2026. In the Carolinas and the inland Northwest, Raleigh and Spokane align in the negative 3.5% to negative 3.7% range. That spread reveals a mutation in the national cycle. Expensive coastal and boomtown markets correct when affordability hits the ceiling. Florida is part of that cohort, but it's carrying an extra layer, post-Surfside compliance, along with a cost structure redrawn by insurance. That is why a forecast calls for Florida's 8 largest metros to average a 1.9% decline in 26, even while the national line is up 2.2%. What does this mean if you need to move? Buyers have more leverage in certain zip codes than they've had in years. In Cape Coral, expectations for larger selection and reduced prices aren't slogans. They're grounded in inventory coming on after hurricane recovery and in sellers adjusting to forecasts like negative 10.2%. In Tampa and Deltona, a projected negative 3.6% could translate into room to negotiate closing costs or secure rate buydowns. In condo-heavy precincts, the question is whether reserves are fully funded, assessments are behind or ahead, and insurance premiums are locked. A building with a completed structural integrity reserve study and funded accounts might carry a higher HOA but lower risk. That trade-off is part of the new buyer's calculus. If you're selling, the strategy is simple but not easy. Price for the market you have, not the market you remember. In places like Denver, the lesson has been that pricing too high leads to longer days on market and deeper cuts later. Florida's version is sharper. Where condo rules and insurance premiums are in flux, overpricing can stall a listing as buyers compare monthly costs across communities. In Cape Coral, where forecasts point to negative 10.2% in 26, a seller who meets the market with realistic pricing and offers incentives could move quickly. In Northport, at negative 8.9%, the same holds. In Tampa, at negative 3.6%, sellers may not need to slash, but should expect buyers to ask for concessions. Policy will set the backdrop. Watch the Florida House's property tax proposals. Slashing taxes on owner-occupied homes could lower monthly costs, shift demand into the primary residence category, and support prices in targeted segments. The trade-offs loom large. Challenges for renters, who don't get the benefit directly. Challenges for buyers if demand lifts faster than supply. And fiscal strain for municipalities, especially in funding police and fire, if revenue falls faster than costs. These are not abstractions. They show up in millage rates, budget hearings, and the amenities that make a neighborhood desirable. Also, watch the implementation arc of condo safety reforms. July brought additional time and flexibility for some associations, particularly around deadlines for key assessments. But where studies were already completed, relief may be limited. The on-the-ground timetable matters. In St. Lucie County, permits moved on November 16th, 2027, and were invoiced by December 5. In that gap, families like the one evacuated in August 2024 had to find another roof, juggle a second mortgage, and navigate a market where rental costs add to the squeeze. The pace of repairs in 26 will decide whether those units re-enter the market as a safe, funded option or remain a cautionary tale with a $43,000 tax listing. There is one more watch item embedded in the data, the condo market's inventory. New rules have pushed many units to list at once. When supply rises faster than demand in specific submarkets, prices soften. In the first half of 2025, median listing prices in Florida were down 6% from the first half of 2023. If inventory builds further in 2026, buyers could see more choice and negotiate harder on HOA fees, assessments, and seller credits. If, however, funding and repairs progress quickly and insurance markets stabilize, some of those listings could become more attractive without deep price cuts. That is the shape of a base case where Florida's 8 biggest metros average negative 1.9%, alongside national growth of 2.2%. The luxury segment will likely keep marching to its own beat. In Manalapan, one owner now controls significant shoreline and is positioning assets in 9-figure blocks. The gravitational pull of a $75,000 furnished estate with a tunnel to the beach has little to do with an $800 monthly HOA fee. Decisions at that level can even steady comps at the top. But they don't set prices in Northport or Deltona, and they won't pay an assessment of $20,000 in Boca Raton. They do, however, remind us of Florida's two speeds. One where money is a moat. One where money is a monthly. How should you prepare? Start with the math. If you're targeting Cape Coral, underwrite a 10.2% projected decline in 26 and look for builder and seller incentives. Rate buy-downs, closing cost credits that change your monthly by 3, 4, or 5 digits across a year. If you're eyeing Northport, consider that 8.9% path and the inventory that could sit for longer, giving you leverage. If you're scanning Tampa or Deltona at negative 3.6%, factor in insurance quotes and HOA escalations with the same weight as price. If you're looking at condos anywhere along the coast, ask for the Structural Integrity Reserve Study, the reserve funding schedule, and any special assessment votes on the calendar. Numbers like $43,000 per unit or $3,000 per building are not hypotheticals anymore. This is what a reset feels like, all at once. In May 2022, Florida's median sale price at $405,900 with a 23.8% year-over-year jump taught buyers to hurry. In August 2024, an evacuation order taught owners that concrete and rebar can age in silence. In the first half of 2025, a 6% decline in median listing prices statewide taught sellers that the list price is a starting point, not a finish line. November 16th and December 5th, 2026, taught one community that the right forms filed and invoiced do eventually turn into repairs. In 26, a statewide average projected to be negative 1.9% will teach everyone that Florida's housing market is a sum of many local parts. Base case then, a cooler 2026 for much of Florida, with average declines of 1.9% across the 8 largest metros, and sharper slides in Cape Coral at negative 10.2% and Northport at negative 8.9%. Buyers gain leverage in selected zip codes, particularly where insurance and HOA burdens are highest and where new home builders deploy incentives. Sellers succeed with realistic pricing and upfront concessions, especially in condo-heavy buildings still absorbing post-Surfside costs. The ultra-luxury coastal tier remains insulated by scarcity, exemplified by a $72,000 closing and a $102,000 two-year footprint in Manalapan, providing a separate anchor at the top. 2 things to watch over the next 12 months. First, the outcome of property tax proposals aimed at slashing levies on owner-occupied homes. If enacted, lower carrying costs could lift demand and prices for primary residences while complicating budgets for police and fire and pressing renters who don't benefit directly. Second, the execution of condo safety reforms in the wake of new deadlines and July's adjustments. Where structural integrity reserve studies are complete, reserve funding and repair timetables will determine whether assessments stabilize or spike. Numbers like $20,000 per unit in Boca Raton or $43,000 per unit in Jensen Beach are the threshold between stay and sell for thousands of owners. A third variable ties them together: insurance. Premium trajectories, $2,300 a year here, $2,800 on an 834 square foot home there, will either ease or magnify every other number in a buyer's spreadsheet. Florida's promise hasn't vanished. It has finally come priced to the risk and to the regulation. The winners in 2006 will be the ones who treat the decision like what it is, not just buying a door key, but buying a balance sheet. If you value clear-eyed, data-first breakdowns of Florida housing, subscribe for the next check-in.